who want an exposure to a market or an
Everything
asset.
they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
For Morningstar, I'm Holly Cook. Today we're looking at 3 stock tips, our regular feature, but we're changing it up a bit for you today and actually looking at the bond sectors. Joining me is Dickie Hodges. He's manager of L&G Dynamic Bond Trust, which is rated silver by Morningstar's analysts. Dickie, thanks for joining me.
Thank you for inviting me.
So normally we look at stock tips here, but of course, with you here in the studio, we're going to be looking at the bond investing environment. So what would be the sector that would be one of your favourites at the moment?
I think it's conventional wisdom in an environment where we've got interest rates lower for longer, the demand which we've still got for an income level of between 5 and 7%, that would dictate that one of the areas which you need to look at is obviously a high yield bond market. Clearly the economy is improving gradually, signs of some sort of recovery, but we're still in this, which is a very good area to be with regard to high yield, moderate growth. And so if you're looking still for a return of around 6%, then clearly that is one of the few areas left in the world's bond markets that can actually deliver that return with, I would argue, an acceptable level of risk.
And so you mentioned their risk. I mean, what is the main risk with the high yield sector?
I think the main risk of the high yield sector is the fact is it's becoming increasingly more expensive. Over the course of the last 3 years, we've seen a compression of spreads, i.e. the yield available on high yield has been getting lower and lower as the demand has been increasing for the asset class. At some stage, if we move into an environment where we are going to see interest rates rising, I would argue that the high yield sector will be much more sensitive to those changes in interest rates. Now that will still give a negative return on prices of high yield assets. So I think the real key thing which we have to get right is the timing of when interest rates rise, either in the US or indeed the UK.
OK, so what would be your second favourite bond sector?
Again, it's all to do with the demand for assets and the demand for a level of income. And again, it's looking to see where you can generate those returns from. Conventional wisdom would still dictate that you would have to look at more subordinated levels of financial debt. Many people would argue that what we class as the core Tier 1 capital ratio has improved. The dynamics and the possibility of future defaults has diminished from the banking sector, and this is Europe-wide. Plus with the support from the implicit support from the European Central Bank. This would lead normally to an environment where subordinated levels of financial debt will actually give the performance that you require. But let's not forget that, again, this is still a very risky proposition, and these are very high beta assets. You know, if you're owning an asset that yields 7%, compared to a government yield of around about 2%, then clearly there is implicitly a lot of risk in that asset class. So you have to be very careful about where you're investing and which country you're investing in as well.
So would the general risks that apply to the Eurozone as a whole be the main risk there for that area?
Very much so, yes. I mean, it's also the ECB. You know, I think a lot of people are factoring in the basis that there is going to be some support from the European Central Bank in some shape or form along the lines of quantitative easing that we've seen both in the US and in UK, and obviously the quantitative easing that we're under, the Bank of Japan are undertaking, and as we speak. So I think there is the environment which we're moving in dictates that you do have to have these assets to get the returns. But again, you have to be very careful about where you're looking to invest.
So we're running out of sectors. What's going to be your third bond sector tip?
This is primarily driven by the implicit support from the European Central Bank. And certainly from my perspective, you've got to look at periphery European debt. And I know it sounds quite strange and it sounds very risky indeed, but one of the best performing bond markets year to date globally has been that of the Portuguese government bond market. You've seen 5-year government bond yields start on the 31st of December around about 5.5%. Today they're around about 3 to 3.5%. You know, you've had a significant drop in that yield, which obviously that corresponds to rallying in prices. So you've seen great performance out of this asset class, but let's put it into context. You know, they're still yielding around about 3%, when 5-year German government bond market is yielding around about 1 or half.
So if you want that extra yield, you've got to take on that extra risk.
You've got to take that risk as well, and there's very few areas, even in the corporate bond market, that can deliver that sort of yield, certainly throughout Europe. So I know it sounds, again, a proposition that might have scared people 18 months ago. But the fact of the matter is, if you're looking to generate a level of capital return and income, you're almost forced to move into these asset classes that have proved cheap.
Well, Dickie Hodges, thank you very much for joining me today and giving us your bond sector tips.
Yeah, no problem. Thank you.
For Morningstar, I'm Holly Cook. Thanks for watching.